Welcome to your video on capital cost allowance. Let's start off with what is capital cost allowance. Capital cost allowance is also referred to as depreciation. In Canada, we use the term capital cost allowance because we use a different approach. It's still considered depreciation and the terms are interchangeable. This is part of the matching principle, depreciation, where you match the costs that are being used for a fixed asset over the time that it's actually being used. So what is capital cost allowance? What is depreciation? It's really the permanent and continual reduction in the quality, quantity, and value of an asset over its useful life. So think about a car. As soon as you purchase a car, a brand new car, and you start to drive it home, it has already lost value immediately. If you try and sell that car, you will not be able to sell it for the same amount as you did. And it will continue to reduce in value over its useful life. For companies, they could, let's say, purchase a car for $25,000. Even if they pay for it immediately, the $25,000, if they record it immediately in their financial statements, that will really throw off their income, their profit, or their loss for that year. What depreciation allows for is for the expenses to be deducted, to be written off from those assets over their useful lives. So what's a useful life? That would be how long a car would be expected to last. Okay? So before we move forward, let's talk about some key terms. So capital costs are costs for a company, for a hotel, for a restaurant, for really any company. It's really a bigger capital asset. You're going to see mostly fixed assets like equipment, like cars, machinery, and we refer to those as capital assets, and they're depreciable property. Okay, so that could be a building, machinery, equipment, and they're all grouped in different classes. Now, we don't get to decide which classes those are. The Government of Canada does, and this is where capital cost allowance comes into play. So depreciation is called capital cost allowance in Canada because the Government of Canada has taken a different approach. So you are allowed to deduct a certain amount from each type of capital asset. You don't get to choose the different approach you want to take to depreciate, to spread out that expense over its useful life. The Government of Canada has different classes, and then they get to tell you what your allowance is for those different types of machinery, equipment, whatever it falls under. Okay. Undepreciated capital cost is how much value the capital asset still has. So every year you're able to deduct a certain amount of expense from that capital asset. Okay, so you can start to deduct based on its class how much it's worth. Okay, so put it as an expense on your income statement and start to reduce the value. Okay? And at the end of the year, you would deduct that amount from the original value. Okay? And then you would do the same thing the year after using the previous year's value. We'll go through an example in a second. But we refer to that as undepreciated capital cost. So it's how much the capital asset is still worth at a moment in time. Okay, so if I were to ask you the UCC, the undepreciated capital cost at the end of year 2, that's how much it was worth originally minus the 2 years of the capital cost allowance. When we go through an example, it will become clear. Terminal loss or capital gain are what you experience when you decide to dispose of the capital asset. If you were to dispose of it for less than what it is worth, that undepreciated capital cost at that moment in time, you would experience a terminal loss. Okay? If you were to sell it for more than what it is worth at the time, you would have a capital gain. You would be making money. Because you've already started to expense that, If you sell it for more, you're making money off of the sale of that asset. Therefore, you have to pay taxes on that. Okay? So these two terms we'll talk about more in your classes. Now, depreciation does have a contra asset account attached to it, and that is cumulative depreciation. On your balance sheet, you would post the original value, including taxes and delivery fees, of the asset itself, the capital asset. So let's continue with a car. So that is considered an asset. A contra asset account has a credit balance which goes against that debit balance of the asset. It starts to reduce the value on your balance sheet. So you will always see the original value of your assets minus your contra asset account, which is your cumulative depreciation. Cumulative is how much so far you have depreciated from that asset, so that you can then find out the net worth of those assets. So accounting for capital cost allowance or depreciation, there's two different ways that we really do it, and that is on the income statement and on the balance sheet. So as you reduce the value in money, value as you record as an expense, you will bring that depreciation for that year over to your income statement as an expense. What it ends up being is it reduces the income before tax, therefore it reduces the taxes paid by the business. Now, like I told you in the previous example, if you purchase the car right away, you are not really using that cash anymore throughout the useful life of that car. You are deducting it, but you've already paid for it. So what happens is it ends up reducing the taxes paid by a business because it's recorded as an expense, but it's not really there. As we go through more examples with your income statement in your courses, you'll see that where that comes into play and how we account for the fact that while this is an expense, we actually add it back because we don't really use that cash. And then in the balance sheet, you have it posted as an asset for the original cost value, again, including your delivery and including your taxes. And then you'll always record the cumulative depreciation as I discussed earlier. So it's a contra asset account and it's a negative asset account. So it would go against the assets themselves. So in Canada we use declining balance as it's been mentioned. There are other options of depreciation throughout the world. Straight line is the simplest and it's a very popular method. The units of production, that's depreciation. It really assigns an equal amount of expense to each unit produced or service rendered by the asset. Some of you use digits and double declining balance. These are both accelerated depreciation methods that account for higher depreciation charge in the first years of an asset's life and gradually decreases depreciation expense in the following years. These are accelerated methods that are used if an asset depreciates more in the first few years. It also allows businesses to depreciate expenses more at the beginning. Therefore, it helps them out with taxes more at the beginning as well, at the beginning of the asset's useful life. For the sake of our course, we will be using capital cost, the capital cost allowance method, so the declining balance method, which we will go through in a second. So the Canadian declining balance method. A business can deduct capital cost allowance on depreciable assets, so those are those capital assets, based on a set percentage rate each year. The rate is based on the asset's classification, as I mentioned. So capital cost allowance is calculated on total cost of the capital asset, including the taxes and any setup costs. Following the first year, capital cost allowance is calculated based on remaining book value of the asset. So that's what I meant by the UCC. So at the end of year one, your asset will not be worth the same as it was previously because you have deducted some of the expenses. It is now worth less. Well, the next year, in year two, you won't start with the original value of that capital asset anymore. You will always start with the value that is at that moment in time. So the end of year one value for that capital asset becomes the beginning of year two value for that capital asset, or the undepreciated capital cost for that asset. There is a rule that you really want to remember, and that is in the first year when purchasing a capital asset, you can only claim 50% of the calculated CCA, capital cost allowance. This accounts for when people are purchasing assets either at the beginning of the year or at the end, in the middle. You will not always be purchasing a capital asset right at the beginning of your fiscal year or right at the end of your fiscal year. By only allowing companies to do 50%, the government believes that this will just wash out everything and it will all even itself out over time. CCA is prorated when asset is sold or removed partway through the fiscal year. Okay, so it's done through a ratio. Let's say you sell an asset at the end of February and your fiscal year, so it's from January to December, you would still account for capital cost allowance, but only for 2/12 of the full year value. So you wouldn't be able to expense that capital cost allowance for the full year. You would only be able to do it for 2/12 of that year. So let's go through an example. Joe's Pizzeria buys a delivery car for $25,000, including taxes. Remember, that's important. It's considered a Class 10 asset by the Government of Canada, CRA, Canada Revenue Agency, which means that it provides a capital cost allowance rate of 30% each year. So each year, Joe's Pizzeria is allowed to deduct the value of that car by 30%. Okay? So year one, we would start with $25,000 because that's how much it was worth, including taxes. The CCA rate is 30%, so you would be allowed to deduct 30% of this value right away in the first year. But never forget the half-year rule. So the first year, you can only deduct half of that amount. So we would first find out what 30% of 25,000 is, so 25,000 times 0.3. And then we would multiply it by a half, and that's that half-year rule. Only happens in the first year. So you would be able to deduct $3,750. This would go on your income statement as an expense. Your capital asset on your balance sheet would be recorded as $25,000. Now, at the end of year one, you would then have a line that would account for the cumulative depreciation, accumulated depreciation so far, and you would deduct it. This would be the value of your asset, your net value of your asset on your balance sheet. So if I were to look at the beginning of year two, all we've done is we've taken the original value in year one minus how much we depreciated, how much we deducted as an expense from that value. So this becomes the undepreciated capital cost, $21,250, the UCC, at the beginning of year two for this asset, for this car. Okay. Now, it was also the UCC, the undepreciated capital cost, at the end of year one. The end of one accounting period becomes the beginning of another accounting period. Always remember that. So the car is now worth $21,250. Now we can stick to just our 30%. So the value of the car, the capital asset at the beginning of year two, multiplied by the 30% is how much we can record, how much we can deduct as an expense on our income statement for that year. And then to find out how much it's worth at the beginning of year three or at the end of year two, remember that's the same thing, we would simply take the value at the beginning of year two minus how much I can deduct in year two. And then that would then give me my UCC at the beginning of year three. And we would continue this process. Now, at the end of year 5, the asset has a UCC value of $77,288.75 because that's the value at the beginning of year 5, minus the 30% of that number is, which is $2,186.63. So the UCC value at the end of year 5 is $5,102.12. So that's the process we would take. Now, capital cost allowance classes, we do not make that up, like I said. So I would suggest you refer back to this website. There's a link within your presentation, or just research it. And the Government of Canada, in particular this Canada Revenue Agency, CRA, have a website that explains. So we just went through let's take a look again, a car. And Class 10 asset, which provides a CCA rate of 30% each year. So let's go Class 10. Class 10, general purpose electric data processing equipment. Oh, here we go, 10.1. So a passenger vehicle not included in Class 10. Motor vehicles and some passenger vehicles as well is within Class 10 itself, or 10.1. You would have to go to these two different links to find out which class that vehicle would fall under, but if you take a look at the rate percentage, they both fall under 30%. Okay? So they really guide you in how much you are allowed to deduct as an expense on a year-to-year basis. Based on these guidelines, you must follow them as a company. As a visual, this is how it would show up on your income statement, on your balance sheet. These would be two ways that it might. So you'll see depreciation. That is a spelling mistake, my apologies. But it would show up under your expenses here. Amortization would be for your mortgage, but it would most likely be grouped together on the statement of income. So it shows up as an expense. And then this is what I was talking about right there. So property, land, and equipment. You'd have your buildings, furnishing equipment, and then accumulated depreciation, cumulative depreciation would be deducted. This would be that contra asset. So how much of these assets has been deducted over time is what that means. And then you would typically have a net value of those, or just a total of those capital assets minus the accumulated depreciation.